According to estimates cited by industry analysts and energy executives, disruptions in one of the world's most critical shipping lanes may have removed the equivalent of hundreds of millions of barrels from global supply chains. And some industry forecasts suggest that market conditions could remain strained well into 2027 if current disruptions persist. If you have been feeling this at the gas pump, at the grocery store, or when you booked a flight recently, this video is going to explain exactly why and what leading analysts say could come next. Stay with me, because this one matters. Welcome to Strategic Dynamics Edge. This channel breaks down the biggest shifts in global energy, geopolitics, and economics in plain language. No filler, no fluff, just clear analysis. If you are new here, hit subscribe right now and turn on notifications. And if you are already part of this community, you know we do not waste your time. Let us get into it. This video is for educational and informational purposes only. The analysis presented here is based on publicly available reports, market data, expert commentary, and news coverage available at the time of recording. Some events discussed involve ongoing geopolitical developments and projections that may change as new information becomes available. Viewers should conduct their own research and consult official sources before making financial, investment, or business decisions. This content does not constitute financial, legal, or investment advice. On May 12, 2026, the CEO of Saudi Aramco, the world's most valuable company by many measures, and a producer controlling more oil reserves than most nations, sat on a public earnings call and made statements that drew significant attention from energy markets globally. Based on public statements from Saudi Aramco, the company's leadership indicated that the global energy market had lost approximately 1 billion barrels of oil supply since the conflict began. Gasoline and jet fuel inventories, they noted, are draining at a pace that could reach critically low levels ahead of peak summer demand. And then came the projection that prompted concern among analysts worldwide. If the disruption to the Strait of Hormuz persists, some industry forecasts suggest market conditions may not normalize until 2027. This is not casual speculation. This is the assessment of one of the most informed voices in global energy, speaking publicly to investors, based on real-time data. And it has broad economic implications for countries and consumers around the world. So let us start with what actually happened. The Strait of Hormuz is a narrow waterway at the mouth of the Persian Gulf. Under normal conditions, the International Energy Agency and other bodies estimate that roughly 20 million barrels of oil pass through it every single day, representing approximately 1/5 of global consumption. When that strait experienced severe disruption following the conflict that began on February 28, 2026, the global energy system did not simply face a temporary inconvenience. According to multiple energy organizations, oil being produced inside the Gulf had nowhere to go. Tankers dropped anchor, on-land storage began filling rapidly, and oil fields that had been running at full capacity began reducing output. Not because the resource ran out, but because with no export route and full storage tanks, continued production had nowhere to go. The International Energy Agency's May 2026 oil market report put numbers to all of this, and according to that report, the figures are historically significant. The IEA found that global oil supply fell by an additional 1.8 million barrels per day in April, bringing total supply losses since February to approximately 12.8 million barrels per day. Output from Gulf countries affected by the closure was running 14.4 million barrels per day below pre-war levels, according to the same report. Observed global inventories dropped by 129 million barrels in March, and a further 117 million barrels in April. Based on the IEA's own published language, the agency described this as among the most significant oil supply disruptions on record in its 50-year history. That characterization, coming from an independent international body created specifically to monitor global energy security, carries significant weight. It is important to note that future market conditions are highly uncertain. Forecasts depend on geopolitical developments, shipping conditions, production decisions by major producers, and global demand trends. Actual outcomes may differ significantly from current projections. With that context clearly stated, let us look at what analysts are currently tracking. According to IEA data, global oil stocks as of late May 2026 were estimated at roughly 101 days of demand coverage, with projections pointing toward a possible decline to around 98 days by end of month. According to analysts, cited by major financial media outlets, this would represent the tightest inventory buffer in approximately 8 years. And the timing matters, because the summer driving season, historically the period of peak gasoline and jet fuel demand across the United States and Europe, has not yet fully arrived. The IEA's own scenario analysis, published in May, does not project market balance returning until the fourth quarter of 2026 at the earliest, and only under the optimistic assumption that flows through the strait begin resuming in the third quarter. If you are finding this breakdown useful, take a second to share it with someone who needs to understand what is happening in global energy markets right now. Drop a comment below and tell us, are you feeling the effects of this at the pump or at the store? Your engagement helps this channel grow and helps us know what topics matter most to you. Now, let us get to the part of this story that most coverage is missing. There's a common assumption in financial media that Saudi Arabia must be quietly benefiting from elevated oil prices. Based on available reporting and analyst commentary, that picture is far more complicated. Saudi Arabia appears to be managing its own significant pressures at the same time as the global disruption is unfolding. According to reports covering the Gulf Cooperation Council region, the Strait of Hormuz is not only the export route for Gulf oil, it is also the primary import route for a significant share of the food supply that Gulf populations depend on. Analysts and regional news coverage indicate that GCC states rely on the strait for a large majority of their food imports. By mid-March, according to available reporting, a substantial portion of the region's food import supply chains were disrupted, with retailers in some areas reportedly airlifting basic staples and consumer prices for everyday goods rising sharply. No level of oil revenue offsets that kind of domestic pressure on a government trying to maintain stability. Reports also indicate that strikes targeted desalination infrastructure in the region, facilities that provide a critical share of fresh water supply in Kuwait, Qatar, and parts of Saudi Arabia and the UAE. Analysts have noted that targeting water infrastructure in a desert environment carries implications that go well beyond the economic. Food supply chain disruption, combined with water infrastructure pressure, creates exactly the kind of conditions that energy revenue alone cannot resolve. Saudi Arabia's backup export infrastructure also reportedly sustained damage. The country's east-west pipeline, designed specifically as an alternative export route bypassing Hormuz, runs to the Yanbu terminal on the Red Sea coast. According to public reporting, the Yanbu refining complex sustained damage from strikes during the conflict. The pipeline itself, according to Saudi Aramco's public statements, reached its maximum capacity of around 7 million barrels per day and became what the company described as a critical supply artery. But the damage to the terminal demonstrated, according to analysts, that alternative export routes from the Gulf carry their own vulnerabilities. Reports indicate that Qatar's Ras Laffan LNG terminal and the UAE's Fujairah export hub also experienced disruptions. According to energy analysts cited in major financial publications, the simultaneous disruption of multiple alternative export nodes has reshaped how the industry thinks about Gulf supply security. Here is what energy economists find particularly notable about this situation compared to previous supply disruptions. According to historical analysis cited by the IEA and independent researchers, previous oil price spikes in 1973, 1979, 1990, and 2008 eventually triggered a self-correcting response. Higher prices attracted investment, production outside the affected region ramped up, and markets gradually rebalanced. According to Saudi Aramco's public earnings call statements, that mechanism does not appear to be responding with the same speed this time. The IEA's May report noted that supply growth expectations from the Americas have been revised upward by more than 600,000 barrels per day since the start of the year, with Atlantic Basin exports increasing by approximately 3.5 million barrels per day since February, with contributions from the United States, Brazil, Canada, Kazakhstan, and Venezuela. However, according to IEA data, this increase covers roughly 1/4 of the estimated Gulf supply shortfall, leaving a substantial gap that analysts say can only be fully addressed by restored flows through the strait itself. The effects on American consumers have been documented across major news outlets. According to public reporting, U.S. gas prices surged past $4.50 per gallon nationally. Jet fuel prices in North America reportedly spiked approximately 95% from pre-conflict levels, prompting multiple airlines to raise fees and reduce routes. Reuters and other outlets reported that Spirit Airlines ceased all operations on May 2, 2026, with fuel costs cited as a central factor. Shipping companies including FedEx, UPS, Amazon, and the U.S. Postal Service implemented fuel surcharges that, according to analysts, flow through to the cost of deliveries for households across the country. Analysts have also noted that the disruption extends well beyond oil. According to industry data, the Gulf region accounts for approximately 8% of global aluminum production, with around 5 million tons of aluminum shipping through the strait annually from smelters in Bahrain, Qatar, Saudi Arabia, and the UAE. Industry reports indicate that roughly half of global seaborne sulfur trade also moves through Hormuz, and sulfur is a key input in fertilizer production. Food security analysts, according to available commentary, have begun flagging this as a medium-term concern for developing nations that depend on imported fertilizer. According to economists cited by major financial outlets, the combination of supply disruption and resulting demand contraction, as higher prices force consumers and industries to reduce usage, creates the conditions associated with stagflation, a particularly challenging economic environment that some analysts have compared in structure, though not necessarily in scale, to the energy crisis of the 1970s. Looking at the longer-term picture, Oxford Energy analysis cited in industry publications indicates that even after the strait reopens, full restoration of pre-disruption export flows could require 6 months or more, accounting for infrastructure repair, tanker fleet repositioning, and insurance market normalization. Analysts have also noted that a geopolitical risk premium may be factored into Gulf crude pricing going forward, as market participants, insurers, tanker operators, refiners, and sovereign wealth funds incorporate the experience of this disruption into their long-term planning. Major Asian importing nations, according to analyst commentary and reporting from financial media, appear to be reviewing their energy sourcing strategies, with some Chinese, Indian, Japanese, and Korean energy companies reportedly exploring greater diversification away from single-source Gulf dependency. It is worth repeating that all projections about future market conditions carry significant uncertainty. Whether the strait reopens quickly, whether infrastructure damage is repaired efficiently, and how global demand trends evolve will all shape the actual outcome in ways that current forecasts cannot fully predict. What analysts and institutions, including the IEA, have confirmed based on current data is that the inventory buffer is at its tightest in approximately 8 years. The supply shortfall remains substantial, and the summer demand season has not yet fully arrived. The question of when conditions improve depends on geopolitical developments that remain fluid, including the status of diplomatic efforts, the condition of physical infrastructure, and the timeline for shipping and insurance markets to normalize. These are variables that no single organization or government fully controls. That is the full analytical picture as it stands today. And delivering that kind of clear, sourced, grounded breakdown is exactly what Strategic Dynamics Edge is here for. If this video gave you genuine clarity on a complex situation, share it right now with one person in your life who needs to understand what is happening in global energy markets. Leave a comment below telling us where you're watching from and how this is affecting your daily life. And if you have not subscribed yet, now is the time. Hit that button, turn on notifications, and stay with us for analysis you can actually trust. Sources referenced in this video include publicly available reports from international energy organizations, including the International Energy Agency, public statements and earnings disclosures from Saudi Aramco, analyst commentary cited in major financial publications, and reporting from major international news outlets. All information is presented for educational discussion and analysis purposes only.